Hello, everyone. This is David Moore with Equity Advantage, and it's time to get started. Looks like we've got quite a few on and quite a few to come. But today's topic is the Reverse Exchange Bootcamp, and it's pretty timely information. It seems like in the 30 years I've been in this business, we're doing more reverse and more improvement exchanges than we have ever before, and obviously it's a result of the marketplace. Reverses are a great tool to sort of get you what you want when you want without having to worry about that awful 45-day ID period. So we've got an hour to get through a lot of information. We're going to start off talking about a couple issues with tax reform that I think are important, people need to be aware of. And then we'll be diving into exchange basics, and then we'll hit the reverse exchange and finish up with some examples of transactions. As far as some housekeeping, there's a menu on the right side of your screen, and if you've got questions that you'd like addressed, you can post a question there. If I don't get to it during the presentation, we'll be addressing them afterwards, so don't be shy with those. And as far as your ability to get real estate continuing education from this presentation, certain areas you can. So if you're interested in that, please reach out to Seymour, C-M-O-O-R-E, that's Celia Seymour at 1031exchange.com, and she'll take care of any needs you've got on that front. Also, if you're not on our newsletter list and you're interested, please let her know whether you'd like to be included in that list and receive information going forward on either 1031, IRAs, or both. But look forward to doing this presentation today. It's quite an entertaining topic, and it's something that's changed a little bit through years, not much, but when I got started in the business in 1991, we were able to do things a little bit differently, and then in 2000 we got a revenue procedure that contains the safe harbors that we now work with. So the idea with this is flexibility and time, and we're also going to be talking about blended transactions where we've got a series, maybe it's a number of properties being relinquished, you're looking to acquire a number of different properties, and through the combination of a reverse exchange and a delayed exchange, or a delayed exchange and reverse exchange, either way, really, we can stretch those timelines, at the extreme to almost a year's time to get transactions done. There's also something where, keep in mind with reverse exchanges, we're talking about a revenue procedure that contains safe harbors. So that's not an absolute that you have to follow those. So there's something called the Bartell case that came out a number of years back, and really that's just a non-safe harbor reverse exchange. And really when that decision came out, it didn't really surprise me at all with what it said. But the bottom line is, if you've got an extreme situation and you've got to make something happen, it might be possible to work outside the safe harbors of the Rev Proc there too. But let's get started, and hope you get these little nuggets of knowledge today. And that's what I love to call them, one little deal. You don't have to have all the answers, you just have to have a place to get them. And please feel free to reach out to us anytime you've got questions on different issues. Even if you're working with another company on something, we're happy to help you out. So first off, like I said, I think it's very important. We're in a market right now that is just absolute craziness. So just for future reference, anyone watching this video in 6 months or 6 years from now probably need to let them know when. On the title page, it says, August of 21, that's where we are. At this point in time, we've had tax proposals issued from the President Biden administration, but we don't know exactly where we're headed with these things right now. We had a verbal amendment to the tax proposal to cap 1031 deferral at $500,000 per person per year. So at this point, it would appear that the 1031 is going to be preserved as is. Please note that we did lose personal property with 2017's tax reform. So prior to that, we were able to do real and personal property transactions. We used to do a lot of aircraft, and you'd have aircraft, helicopters, artwork, businesses, a variety of different assets, but that was looked at as a 1%er issue. And so we lost that and actually gained the opportunity zone. The OZ, or opportunity zone, I think is a great play for people getting out of other asset classes into real estate. I don't really look at it as a great option if you're going real estate to real estate. I do look at it sort of, and compare it to, let's say, a Roth IRA, where you've got limited tax deferral into the investment, and then after you've made it, if you hold it through the investment life in the OZ world, approximately 10 years, you're going to have tax-free gain in that situation. So it can be a very good deal. But today we're talking about 1031 and what's been proposed here that's going to impact real estate and really, for that matter, all of estate planning and business as we know it. So the primary concern we've seen focused on is the cap at 1031.5 million per person per year. Now keep in mind that per person could mean, if you've got a property that's owned by a limited liability company with a half dozen owners, members of that entity is only entitled, would only be entitled to the $500,000. So hopefully that does go away and stay away. It would be a tough situation. We've already done some planning on with clients, because any change in 1031, if it were to occur, is set to be applied to 1/1/22. Some of the tax measures are actually retroactive to April of 21. So we're in a market that's moving very quickly, and I think it's in an effort to get people where they want to be before any tax laws change. You need to understand that even if you're getting something done right now, you might not really know what kind of tax hit you're going to take on that thing, which is a scary deal. Now, if they were to actually implement a retroactivity on this, I could imagine we're going to have the courts just filled with cases, because imagine completing a transaction in something and you thought you were looking at maybe a top rate federally on a long-term gain at 20% on appreciation, 25% depreciation. Now you're looking at what was proposed to be as much as 39.6%. I mean, that's a brutal deal to be hit with, and you're going to throw state tax, and we still have the healthcare tax on top of that. So you could be at 39.6 Fed. A state like Oregon, for example, you could have 12 to 15 if Multnomah County gets its way on top of that. So, that gets you to 55, another 3.8. You could be almost 60% tax on that if everything went forward the way they're proposing it. Now, we've got that increase in capital gains tax rate. Like I said, it's proposed to be retroactive to April 26th of 21. I can't imagine they do that, and really, it's another reason to reach out to your representative and say, hey, don't do this. This is going to just stagnate the marketplace, really slow everything down. The other issue, so 1031's gotten a lot of spotlight, but the increased capital gains is going to be very, very difficult, obviously. The elimination of the stepped up basis. So historically, one of the great things about 1031 was you could swap till you drop. Well, the exchange, and ultimately when you pass, your heirs would receive a stepped up basis on those assets, and they could turn the next day and sell with no capital gains tax. So obviously politicians don't necessarily like that, but they're looking to eliminate that stepped up basis, go to market also on gifts. So I mean, in the estate planning world, think about transferring assets. I mean, if you're looking at a cash gift, we're currently looking at $15,000 per person per year. But if you're gifting an interest in an asset, you can, in today's world, you can actually discount that value on a minority distribution or gift to as much as 40% discount, which is once again another wonderful thing, but it's on the chopping block. So be aware of that. If you're trying to move things, you're trying to do some gifting before laws change, make sure you're talking to your tax people now, sooner rather than later, so you can understand what's being proposed and maybe how you can address these things. So on gifts, we'd look at mark to market. Another issue that is very, very critical to real estate, and it would change things dramatically, is mark to market for distributions from LLCs. So think about a limited liability company, and think about even a limited liability company with spouses as members. So for example, California or Washington, community property states, spouses can go through an exchange in and out of a limited liability company. In other words, they could give up a property owned in an LLC, go out and buy the new property personally, and then shove it back in the LLC after acquisition if they want it. And understand that this is probably the second biggest issue we have in the 1031 space, second only to time, is vesting. And we joke about it in here, vexing vesting, and just changing ownership and stuff. Now understand, rarely do people use, and really you shouldn't, S corps or C corps own real estate. If you got a multi-member entity, just taking the asset out of that thing, just taking it out of that corporation is going to trigger tax and actually eliminate any benefit of doing an exchange afterwards. So they want to apply those same rules to limited liability companies, which are used by everybody in real estate. And as I said, even with spouses in for example, Oregon's not a community property state. So imagine you buy one property, then you get another, then you get another, then you meet with your lawyer and says, hey, you ought to shove these into a limited liability company for protection. And so you do that, and then you go to relinquish that property or those properties. In Oregon, you would have to buy the new property in an LLC if you relinquished it in an LLC as spouses, where in California or Washington and in community property states, you can go in and out of the LLC through the exchange. Now, it gets more complicated if we've got 3 or 4 people in there, and we're not talking about spouses. 1031 prohibits application to partnerships. So you're really in a situation where we have lots of transactions where we're acquiring properties, tenancy in common with a group of people, maybe to do a project. They'll contribute their LLC or their TIC interest into that limited liability company, do the project, and then maybe a year pre-disposition, they do a drop from that entity back to the TIC structure, which would then allow the future sale to allow people to go different directions. That would be something that would no longer be possible. That distribution back from the entity out would trigger tax and destroy any benefit of the exchange. So the entity could do an exchange going forward, but the members could not. So imagine what that impact would be to real estate and the liquidity of the marketplace. Think about what's called an UPREIT. So an UPREIT, you can't exchange directly into a real estate investment trust, but you're going to exchange. An UPREIT is, in a nutshell, something where you're buying into an asset that's absorbed by that REIT. And in today's world, that can happen. If they go mark to market on these things, that's going to eliminate that whole option and really that whole industry. So it's one of those things where I love UPREITs. I think they're sort of the ultimate installment sale. If this stuff happens, it's just going to shut it down. So I don't look at any of these measures as positive for society in general, but definitely for anybody in real estate, if you're looking to do some estate planning, and whether it's gifting or just transferring assets back and forth in and out of entities, you've got to be looking at these issues sooner rather than later. Don't use your tax people as tax preparers. Use your tax people to plan your life. Get good ones that are going to, really, they know it. You're not paying them to learn. You're going to pay somebody for an opinion on stuff and pay them to help you get where you need to go, you and your family. But once again, 1031, if there's any change, it would be effective 1/1/22, where some of the tax reform measures would be retroactive to April 26 of 21. So before you decide just to go sell something, make sure you do whatever you can to figure out what potential tax rates are going to happen. Now, I've got a slide in here talking about what people are up to right now, and there's a fair number of people that might just set up an exchange to buy 45 days to see if they can get any clarity on where we're headed with tax reform before they decide whether they actually have to complete the exchange or they just want to terminate the transaction and receive their funds on day 46. This stuff is big and it's out there and you need to be aware of it. So this is, according to Ernst & Young, the whole talk with 1031, the federal government looked at a situation where they thought, hey, we're going to realize an additional $6-7 billion a year in revenue if we limit 1031 to that extent. And Ernst & Young came back with numbers the exact opposite, to about the effect of threefold. So instead of having a positive net tax consequence, they would end up losing revenue to, instead of gaining 7, they're roughly 20 in the negative direction if these things were put in place. But what's Ernst & Young know, right? So if you're interested in helping out with this, you want to let your representatives know what's going on. The Federation of Exchange Accommodators has this website up. It's got a button you can push to reach out to your representatives. I would encourage you to do that. And the primary reason, obviously, it's one of those things that appears to be very self-serving for us if we're promoting the 1031 surviving year. But the reality of the marketplace is this. I mean, if you don't allow liquidity of market, allow market velocity to occur, you're going to have a situation where the normal income tax just goes away and the property values, or not values, but quality actually start declining. We all see properties where the owner doesn't want it. Well, why hasn't the owner given up the property? Well, maybe they don't know what options they've got. Sign up for an in-game presentation we've got. If you just search us on YouTube, there's a presentation up there that we talk about different in-games that are outside of 1031. And there's a variety of options that are there today. But the reality is, if we don't have properties turn, when was the last time any of you on this call bought a property and did not improve it? Or when you sold the property, the buyer did not improve it? It always happens. So every transaction ends up, leading to improved property quality and a whole bunch of normal income tax. Think of one real estate transaction not happening. Think of the people that are paid in one transaction. You've got obviously title escrow people, finance people, property managers, brokers. You've got Home Depot contractors, inspectors, appraisers. All of these people are paying tax on this stuff. One of the battles that 1031 always has is that Wall Street says, well, we don't have 1031, why do you? Well, Wall Street's also got roughly $30 trillion in qualified IRA 401k money, which has automatic deferral. The other thing that's a big difference between real estate and Wall Street is the entire time you own assets, for those of you out there that have them, you know it. I don't need to tell you, you're painfully aware you're paying tax the whole time you own it with property taxes. So it makes a big difference with what's going on. You're also paying tax on the income of the asset during the time you own it. So with a stock, you're only realizing that tax consequence on disposition typically. So if you'd like to help, or you're concerned about capital gains taxes going away, or you're concerned about your ability to move your assets to your heirs in the future, elimination of step base is going to be a problem. Mark to market on gifts is going to be a problem, and the minority discounting. So minority interest discounting, once again, I'm going to state, if you've got gifts that you want to make, I mean, you can discount those if it's a piece of something instead of cash. You can discount that gift by up to 40%. And if we're looking at distributions in the retirement world, you're taking assets out, you're taking a piece of something, that same discounting could be applied in today's world, where if these measures go forward, we're going to lose that component also. If you've got further questions on this, as I said earlier, please reach out to Seymour at 1031exchange.com, CMOORE at 1031exchange.com. And thank you for any help you're willing to help us with. Thank you. Into the PSAs. So why real estate today? Anybody think we're in an inflationary period? I mean, just look at what's happened with gas prices, so on and so forth in the last 8 months. But if we're looking at what your hedges are against that, typically you're going to look at tangible assets. We all hear the ads on the radio for gold, silver. We see the ads on TV. I mean, what are they selling? They're selling it as an inflationary hedge. It's a tangible asset. Now, I'd like to say the real estate, I believe, is the ultimate tangible asset. And although it's considered an alternative investment, as our gold, silver, it's the oldest investment known to mankind, typically. So if we look at the benefits of real estate, you're not banking that the thing's going to go up. It's a tangible asset and therefore an inflationary hedge. You've got somebody buying the property for the cash flow. You've got leverageability with these things, obviously through the loans, interest deductions, mortgage pay down, depreciation, appreciation, and at the end of the day, at least in today's world, we've got long-term capital gains tax rates, or you can kick the ball down the road using a 1031. So it's a wonderful situation today. Real estate, the ultimate tangible asset. If you've got it and you're selling it, it's a great time to sell. It's not a wonderful time to buy. You're going to be hustling to do it, but we've got lots of people moving their assets into different regions that they may find more preferential via either increased ownership rights or maybe just reduced tenant rights. But we've got lots of people trying to get places. This last year through COVID, it's been very difficult for people when their tenants have been taking these vacations of payment. And we've got a number of owners that are concerned about things, and hopefully we'll be on our way and out the other side of this thing before too much longer. Current trends and issues. You've got to understand, if you put money into an exchange, we've got a lot of transactions right now that are partial transactions. Somebody wants to pull some money out to plug a hole somewhere else. Maybe they just want to take a trip. 1031 is not all or nothing. in a nutshell, every dollar you spend over the tax basis of the relinquished property is going to represent tax deferred gain. I never make assumptions on at what point an exchange ceases to make sense for somebody, because I've got people, I think the smallest exchange we ever did was about a $5,000 gain. At that point, I think we're charging about $1,000 for the exchange. The exchanger was a CPA, and I said, look, you're only saving a very small amount of money, $1,500, $2,000. You don't want to pay it. And so, that's an example of small transaction. On the other side of the coin, I had somebody one day, I'll never forget, he had roughly 800,000 in tax, and he said, "No, it's not, I'll just pay it. It's not that much, so I've got the money free to go do something." So I never make assumptions on where that line is drawn on rationalizing an exchange, but we're doing a number of partial transactions these days. We're going to talk about when you can get access to money. Now, I understand that 1031, like I said, it's not all or nothing, but you can only get money out of the transaction at certain times. So if you know you're going to pull money out, I would encourage you to do it at close. If you're not sure how much money you want to pull out, then all the money's going to come in, and then we're going to talk about this whole distribution of proceeds issue in a little while. But it's one of those things you need to be aware of, because do not ID properties just in case on the 45th day, because if you do, the money's going to be stuck with us until day 181, and that's not a conversation I really want to have again with people. We try to let people know up front, look, you can only get money in these situations. As I said, we'll talk about it in a little while. Partial exchanges, as I said, every dollar you spend over the basis represents tax deferred gain, and so we're doing a number of partial transactions today. A lot of people are giving it a shot. They're just buying 45 days. So they'll get started in the exchange, and maybe they're just doing it with the hope that they've got some clarity on the actual tax consequence of a future sale. Maybe, we'll have the politicians all, reach a compromise and get us some guidelines on what we're going to be looking at going forward. And maybe that 45 days gets you to a point where you can see that, where maybe today you're feeling a little bit naked with no understanding of what you're really going to pay in taxes. We've got a fundamental shift I see in the ownership of real estate, definitely the big stuff. But I live in the People's Republic of Portland, and we're seeing definitely a shift. The mom and pops that have historically owned properties are just no longer able to deal with the rent control issues, or tenants not paying. They don't have pockets deep enough. And you've got a situation where they're just tired, and so we've got people giving up properties, going into things like DSTs, TICs, other passive investments, opportunity zones. But the buyers are a lot of institutional money's coming in. So we've got apartment complexes that historically have been privately owned, now they're publicly owned. And I would put it out there to the politicians out in the audience. Think about what happens. You're going from a mom and a pop that will actually care about the tenants and work with them on things, to an institutional investor that really just doesn't care that much. And the other thing, you got to combine this issue with rent control and understand that, at least in our region, the new buildings are exempted from some of the stuff, where a 15-year-old building or older is subject to the rent control issues, which means that the owners can't afford to maintain these things. And in a turnover, that buyer, is the buyer going to be willing to pay the cost of doing the improvements, buying the property, do that value add, turning that project around? So these are all things that we're seeing, dealing with every day, and that's just really, we've got a real flight of ownership from blue states to red states, just because the people are wanting or needing, for their own mental sanity, some control of their assets again. DSTs, TICs, OZs, passive investments, tired of the terrible T's, toilets, trash, tenants, turnover, that's where they're going. Finally, we've got a number of transactions where people are looking at their retirement accounts. They want to diversify out of Wall Street, so we're combining IRA 401k money along with 1031s in many cases. And using that structure, we're always going to need to, although we could own property in that combination via limited liability company, with the planned money and personal money, or if we're combining it with a 1031 prohibits, once again, the exchange of partnership interest. So we're going to have to use a tenancy in common structure if we're combining qualified money with 1031 money. So this slide, I always say, if you're a broker, I'd take this thing out every time you go on a listing appointment, take a look at what's going on, what that property is, what it appears it is. So 121 applies to a primary residence, 1031 applies to property that's been held for investment. Something that might fall in between the cracks here, between these two, would be section 1033, involuntary conversion. You would also have a situation where maybe you had a property for investment, you haven't held it long enough to be able to do an exchange, or maybe you've got a primary residence that you've only lived in for a year or 18 months, and section 121 applies to property that you've lived in for 2 out of the preceding 5 years. Now, normally you're going to look at these 2 columns and think, okay, what is this property? But it's also possible a single asset could contain both of these tax codes too. Imagine a duplex, half owner occupied, half non-owner occupied. Imagine a large acreage property. You've got the house and then you've got the land, the same situation. Maybe you've got a bed and breakfast. You live in a piece of that property. Some of it, you're going to have an allocation 121. You're going to have an allocation 1031. So we can go, and furthermore, think of this. We can actually convert a residence into an investment, and investment into residence, and there's reasons to do both of those things. So for example, you want to exchange into a property at the beach that ultimately you retire into, you can do that. And there's rules in place to allow you to do that. There's timelines in place. If you want to do that, talk to us. You've got to be aware that you need to hold that property for no less than 5 years before selling it, but don't expect to be able to exchange into a property, convert it, and then take the exclusion after you've lived in it for a couple of years. You're going to be subject to something called the Housing Assistance Tax Act of 2008, and that's, once again, that tax act in and of itself is a 10-minute conversation probably. So there's rules in place that allow you to do it. Now there's reason to convert a primary residence into investment. Imagine, think about 121. It came into play in 1997, 250,000 and a half million. Those exclusion numbers, 250 individually, $500,000 for a married couple, those things meant something in 1997. I would say those numbers need to be probably 500 and a million today. I mean, it's just totally inadequate for today's property values. So we've got lots of situations where somebody's got a gain well in excess of 250 or 500. They could move out of the property, sell it within 3 years of moving out. They're still entitled to the 250 or 500, and then the overage would go into 1031. So there's reasons to go from 121 to 1031 and vice versa, and really just ask those questions. The only dumb questions are the one you don't ask. So there's lots of opportunities there. There's reasons to go back and forth on these things. So how long is long enough? This is one of those big fallacies in the 1031 world. People say, well, the code says 2 years. It does not say 2 years. If I'm exchanging properties with a related party, so my brother, let's say, if we swap properties, we need to hold each of our respective we both have to do exchanges. We both need to hold our respective replacement properties for no less than 2 years. So, that's in a related party transaction, but that's not an absolute, even with a related party. I mean, if you read the fine print, it says unless there was no intent to avoid tax. So do you have to hold it? Is 1031 an effort to avoid tax? I don't know. That's why you've got good tax people, all right? So, this resync court case cites, if somebody asked me how long I'd like to see them hold, I'm going to tell them a year. I'm going to base it on 2 factors. One, has been proposed for 1031 several times. 2, the break between short and long-term tax rates today is at 1 year. So I think there's 2 reasons you can point at a year and be comfortable with it if it's an arm's length transaction. This resync court case was a situation where 4 months was deemed long enough in court. And what happened is that people exchanged out of a property into a new property, documented listings, documented showings, argued they intended to hold it as an investment property, couldn't rent it out, lease it out, ended up moving into the property. They got audited, taken to court, and they prevailed in court after a 4-month hold. So, I'm not saying 4 months is long enough, but it might be for you. That ultimate hold period is up to you and your tax people. Obviously, in the times of COVID, we've got a situation where lots of people bought things with the intent to hold them, and now we're upside down in this world, and so they're needing to make a change. Maybe it's health purposes, maybe it's financial purposes. So Section 121 would allow a proration of the 250 or 500 in a hardship. So talk to your tax people about that. In 1031, once again, there's no stated required hold period in the code. It's up to you and your tax people, but it really has more to do with intent. When you bought the property, what was your intent during the time you owned it? What did you do with it? So on and so forth. If you want to sort of apply, we apply this Clarkowski court case, 9 points used to determine dealer status. The service doesn't want people flipping property and getting rid of all the tax. So it's really aimed at that. That's that hold situation. But as far as how long you need to hold it, it's really up to how often you've done things, what you do with the property during the time you owned it, when did you buy it, whether you actively managed the thing, for sale, let's say, or listed the property with a broker. So an unsolicited offer is totally different than you buying a property, putting it on the market, or buying a property, building something out immediately upon completion, putting it on the market. So you've got to hold something. 1031 applies to property that's been held for investment and is acquired with the intent to hold for investment. But I want to stress, the code does not contain a stated required hold at this point in time. So for basics, we're going to establish some base knowledge on this before we hit the reverse stuff. One, it's got to be an exchange. Something's given away, something's received. A reverse exchange, you're just buying something first to replace something yet to be sold, and the exchange is going to happen at a different point, whether we're doing a warehouse replacement or warehouse relinquished. But something's given away, something's received. What's given received have to be of like kind. The like kind requirement's very broad. It just refers to the nature of the investment rather than the form. Excuse me. So like kind, you can go from dirt in apartments in office buildings, places at the beach to move into at some point. All those things are going to qualify. Even a 30-year leasehold interest or a lease with extensions to 30 years constitutes like kind real property. So we've got a variety of things you can do. I used to have people that come up and say, oh, I remember when it meant house for house, land for land. That's never been the case. It's always been nature rather than form. Now, it's been proposed that they have a true like kind several times, but typically they're bundling it with some other things, and it has gotten shot down historically. So like kind refers to nature rather than the form. For you to be totally deferred, you need to go across or up in value and equity. We call that the napkin test. A big fallacy there is replacing debt in exchange. A lot of times people will say, well, you have to replace your debt in an exchange. That's not true. Debt can go away two ways. One, by going down in value, which triggers tax because you went down in value. The other way debt goes away is by adding cash. Now think about in a recessionary time, what happens with the lenders? We're going to have typically an erosion of value. So we've got a reduction in equity, and we've got a reduced LTV when you go loan to value, when you go to buy the new property. So we have this conversation many, many times during recessionary periods because people are having to come out of pocket money to buy things. And sometimes I'll get a question, hey, do I need to pay? I don't want any debt on the replacement. Do I need to pay off the relinquished property pre-disposition? And the answer to that is absolutely no. You do not have to. You can always add money to the acquisition property to get you where you want to go. Finally, we've got to have continuity of vesting, and that basically just means the taxpayer that relinquishes has to receive. We joke in here about vexing vesting. I mean, it's just crazy how often vesting gets to be a problem. And we talked about it at the very beginning when I talked about LLCs with the mark-to-market on distribution. So a drop and swap or a swap and drop, those are partnership transactions where we're taking an LLC and a drop and swap basically means we're going to bust the entity into a tick pre-disposition. A swap and drop means we're going to go out and buy whatever properties the taxpayers want in the entity's name, and then after we've completed acquisition, you then drop into it. You would drop each asset out to the given owner's position. So you're going to be busting entities on one side or the other. So we're going to talk about that a little bit more in a few minutes too. So the timelines, biggest headache with any exchange, 45-day and 180-day. 45-day ID period, 180 days total time to get it done. Reverses have the same 180-day timeline, and really you've got 45 days from acquisition to ID what you're actually going to be relinquishing in that situation. So it's just the opposite. But 180 days, and keep in mind, late in the tax year, it's 180 days of the due date of the tax return. So if you're closing transactions late in the year, do not file a tax return until you've completed the exchange. If you file a return before you've completed the exchange, you've now torpedoed the transaction. It's done. So do not file your return prior to completing your transaction. All right. And by the way, these timelines cannot be extended for anything other than a presidentially declared national disaster. We had never in the history, 1031 is 100 years old this year, and we'd never had an extension for any reason until 9/11. And then since then, now we've got extensions. Last year, for example, in Oregon, in California, we had extensions for fire, we had extensions for COVID, we've had extensions this year for storms, hurricanes. Flooding, a variety of things that have done that. And you've got to be able to document that you're actually impacted by this catastrophe for you to have some type of extension granted. Property ID, you've just got to meet one of these three rules: 3 property rule, 200% rule, or 95% rule. Basically, 3 property rules the most liberating, I guess I'd say. The 200% rule says that you can ID more than 3 properties. Total value of the properties ID'd couldn't exceed 200% of the relinquished property's value. What's the property worth? I mean, what is that? I mean, it's not like it's worth what it's listed at. I mean, it's a meeting of the minds, highest best use. So keep in mind that a property does not have to be listed on the market to be identified. You're just going to give typically what the government would deem an unambiguous description, which could be a common address, including city, state, and zip. If you're going to buy a piece of something, you need to identify the portion you're going to acquire. Maybe not if you're getting a majority of the asset, but if you're getting a minority interest, you need to receive substantially the same thing as what you ID'd. So you want to put a number on those things or a percentage on it. Now, the third rule says you can exceed 3, you can exceed 200%. You got to close 95% of the aggregate value of all properties ID'd, which means you're closing literally everything you've identified. You have one sale fail, you're going to have a problem. So do what you can to minimize the impact of these rules, and really from the time you've listed a property, or maybe in advance. This class is about reverses. You're finding the property replacement before that property is relinquished. I'm going to say that a reverse, I think, is a great tool. I'm also going to tell you, use it as a fallback. Don't use it as a primary. So when we're looking at a reverse transaction, let's just set it up. Find your property, make the offer, get it tied up, let us know the deal's in escrow. We can get all the ducks in a row ready to go either way. And then hopefully we're going to get your relinquished property sold pre-acquisition. If we can't, then the reverse is there to take care of things. So once again, timing is critical. Ask for whatever time you feel you need, whether it's on an acquisition or a disposition, to get you where you want to go. And we're going to use the structure of exchange that's needed to get you taken care of. This slide is critical in today's world. All right. Now understand we've got a fair number of people right now that are just sort of setting up an exchange just in case. They don't know if they're going to complete it. Maybe they're just doing it because they don't know what the tax hit is today, and they don't want to realize that gain until they know where we're headed with tax reform. So this slide is very, very important for a variety of reasons, but the opportunity zone, for example, I've got it bold on the bottom of this slide. Understand an OZ, you've only got 180 days. It's the same 180 as 1031 contains to commit and get some money into it. So if we've got your money and you shift gears, you say, hey, I want to go into an OZ instead. Well, if you're inside the 45 days, we can give your money on day 46. If you terminate inside the 45, and you have no ID there, you're not entitled to buy anything after the 45th day. Therefore, we can give you their money. We can't give you your money for any reason inside the 45 days because you cannot receive it until you've acquired everything you have the right to buy. Now, after the 45th day, you can only get the money after you've purchased everything you have the right to. So on our ID form, when you're working with us in our ID packet, the ID form has some lines at the top, and for you to put your properties in. Down below it, there's a paragraph that says you have, there's a blank in there. It says that you reserve the right to buy blank of those properties. So if you're IDing 3 properties with the intent that there's 3 different properties, each one to satisfy your exchange, then you would want to put 1 in that blank. And as soon as you've closed out 1 and we're outside the 45 days, you're entitled to the balance of the money. If you did not put the 1 in there and you put 3 properties in place and you had, let's say, $50,000 left after we bought the property you really want, we can't give you the balance of your money until day 181. So it's really important in today's world you understand when you can get that money out. These rules are called the 1031 G6 rules. And any company that's in the exchange space that's not following them has flawed procedures, and the government has told us point blank that if you don't work 1031-G6, not only is that person's exchange invalid, but every exchange done using that policy or procedure is invalid. So it's a very serious thing. Nobody in the exchange business that does this full time and understands is going to give money outside what's called 1031-G6. Warehousing transactions, that's why you're here today, all right? You want to know what's going on with this. You want to understand how to work things. The warehouse transactions could be a situation where we're taking a property that you don't really want as partial consideration for a purchase. In that situation, we warehouse the property. So we'll take the cash from the sale and the property from the sale, and then we turn, we sell that property, convert it to cash, then complete the transaction, the acquisition. Or that property comes to us, and if the person doesn't want it, maybe we can use the property and cash to go buy something. But that's a warehouse transaction. If we gave you the property at time of disposition and you didn't want it, you went to sell it, you'd have another problem there. So we don't want that to happen. So we could do a warehouse transaction if we're just looking at parking assets. Warehouse transactions are typically structured, they have to be structured in reverse exchanges and improvement exchanges. Reverses, the government has said you cannot own the new and old property simultaneously. So a true reverse, and for those of you that don't really understand that term, pre-2000, we used to do what I would call a true reverse exchange. You would show up at the acquisition with the money required to buy that property. We'd sign a note saying we borrowed that money from you. You close on that property and you own it. You would own the new and old properties at the same time. When the old one went away, the proceeds would come in as it normally would to us, and then we'd take the proceeds, pay you back the debt we've got. Now, that is not okay. That's not one of the transactions that's in the safe harbor. The safe harbors require warehousing or parking property. They prohibit your ownership of the new and old at the same time. So we've lost that piece. That Bartel case I mentioned earlier, you still might be able to do it, but it's one of those things you're going to have a serious sit down with your tax people. We'll be happy to participate with you. But anyway, that's working outside the safe harbors. So a warehouse relinquished reverse exchange means that we're going to take ownership of the old property. So we're going to buy the new one, give it to you, take ownership of the old one. Warehouse replacement means we're taking ownership of the new one. Improvement exchanges are really, in essence, a warehouse replacement transaction. I mean, we're going to create an entity that takes ownership of the property, goes vertical on it, conveys the improved property back to the taxpayer. Blended transactions actually are a combination of delayed exchange and reverse exchange, or it might be a reverse exchange and delayed exchange. It's a variety of different things, but we can combine, and we're typically looking at blended transactions. We've got a number of properties that are being relinquished or acquired, and we're going to talk about that a little bit more in a minute. So reverse exchanges, just like a delayed exchange, you've got 180 days to get the deal done. We actually, for ours, we know what you're selling, so we actually integrate your relinquished property into the exchange agreements up front. If you don't know, then you're going to have to ID what's going to be done. But you've got that same 180-day timeline to get things done. We cannot have ownership of the new and or old property. We cannot, the exchange company cannot warehouse property or properties for more than 180 days in any one given transaction. So a warehouse replacement reverse exchange means that we are going to create what in the exchange world is called an EAT, an exchange accommodation title holder. That EAT is going to buy that property. So you, the taxpayer, if you've got, number one, we're not going to do a reverse exchange if you don't have the ability to buy the property today to replace something yet to be sold. Exchange companies don't loan money. So the taxpayer has to have the financial ability to get this deal done. If the taxpayer does, then we can do the reverse. So in a warehouse replacement reverse exchange, we're going to provide all the exchange documentation that's necessary. We're going to put the EAT together, which is just a fancy acronym for a single member, single asset limited liability company that we're the member of, that we as in the exchange company is the member of. So you, the taxpayer, are going to show up at the purchase with the money required to buy that property. We're going to, create a note between you and the EAT, and that EAT is going to take ownership of that property and maintain ownership until your property sells in the future. When your property sells in the future, the proceeds are going to come in from that sale, and we're going to use them to pay back any debt we've got to you. If we've got additional funds funds beyond that loan, we can then pay down the debt on that property, or we could build something on it, or you could buy something else. But the beauty of a warehouse replacement is, one, we can do improvements. Two, if you've got fewer funds available than what you expect net in the future, we can actually bury all those funds into that property upon that future sales, proceeds coming into us. So warehouse replacement is more flexible. It's easy to transfer the asset back to the taxpayer. I like doing an assignment of membership interest. So instead of just doing a generic limited liability company to warehouse the property, we'll actually work with our client and weigh what state of registration do you want, what name do you want, and we'll put the limited liability company together in the state of registration and name that our taxpayer ultimately wants to own the asset in. And by using that structure, if we're talking about an individual or spouses in community property states, or we're doing an exchange for an entity where the whole entity is going forward, we're just going to take ownership in the EATS name, in that name that the taxpayer wants. We assign a membership interest from us to the taxpayer to complete the transaction. The title policies are in place still because they're all in the name of that entity. If there's improvements being done, nothing has to change because, once again, the ownership doesn't shift. If there's a loan in place, nothing has to be changed because the actual deeded ownership has not changed. The membership interest has. So that's why I like doing assignment of membership interest, to convey that new property back to our taxpayer. Sometimes that's not possible. For example, spouses in Oregon, we're not a community property state, so even though we could use that assignment of membership interest for clients in California or Washington, we can't do it in Oregon, and because the spouses cannot go into or out of an LLC through the exchange. So that's sort of the easiest reverse structure, is the warehouse replacement. A warehouse relinquished means that we're going to create the entity, but it's going to be used to warehouse the relinquished property. So you're still going to show up purchase with the money required to buy the property. We're going to buy that property, and it's direct deeded to you, and you're that new owner. So if there's a lender involved, they're going to be happy with you. At the same time the acquisition happens, the property to go away is deeded over to us. That exchange, technically speaking, the exchange is done at that point. The only thing left to happen is that we have to repay a debt that we've got to you. And by the way, during the time we own these assets, typically the taxpayer is going to manage the asset and have the benefits and burdens. As long as we're working within 180 days, the government said that's okay. If we're working outside the safe harbors, then we have to have skin in the game, and we actually have to be involved with that stuff. We have to have part of the upside, and unfortunately some of the downside, where typically in reverse we're not going to be doing that. When we're working inside the safe harbors, our clients are able to enjoy some of those benefits. It's not yours to take depreciation on. You're only going to be able to do that on the asset you own, or that you've still got ownership of. But depending on what's happening here, the warehouse relinquished transaction allows the lenders to finance you, and actually you're going to take direct ownership, which makes them happy. The date of acquisition, the relinquished property is deeded over to us. When it sells, the proceeds come into us, and we're going to use them to pay back any debt we've got to you. Now, the problem in that transaction is that when you've got those proceeds, any residual funds, we can't pay down the debt on that property that we've already given you. So the warehouse relinquished means that we're only able to, maybe from that sale, maybe we have some time in the 180 days left, but we've got to look at those timelines, and then it might be possible to use what we're talking about in a minute, a blended transaction. We're combining a delayed with a reverse. So for example, if we had a few properties come in, or you had to buy first, and if you are maintaining, if we do a warehouse replacement reverse, it's great because we have the ability to actually take ownership. The exchange is not happening until your property sells. So that warehouse replacement, the other benefit of that is shifting gears into the blended transaction, because from the date of acquisition you have 180 days, and then from the date your property goes away in a warehouse relinquished, we'd have 180 days to buy any additional property. So that's another benefit of the warehouse replacement reverse exchange. So here's a few of the requirements. We've got to use the EATS. We've got to have it own either the relinquished or replacement property. You're looking at, somebody's intent to hold for investment. No later than 5 days after the transfer of the property to EAT, we must have that qualified exchange accommodation agreement in place. Working with us, we do all this stuff up front. We don't buy or sell anything without having our contracts in place. So, that second component really is sort of a moot point when working with us. And we really know what's going on. As far as number 3 is concerned, we are going to, unless you don't know what's going to sell, you're not sure at all, we're still, if you've got multiple assets, you're not sure, you're going to be looking at those ID rules. So, maybe you keep it 3 or fewer, but typically you're going to be giving up a single asset. We actually integrate that into our exchange agreements up front, so it's not a problem. And then number 4, we've got a total of 180 days that we can be on title to the new and or relinquished properties. We can't stretch beyond the 180 if we're working within the safe harbors of Rev Proc 2000-37. So blended transactions. Once again, what we're doing with a blended transaction is we're combining a reverse exchange and a delayed exchange, and we can once again stretch those timelines all the way up to maybe 360 days. I mean, it's possible to go that far out. So once again, using that transaction, if we're buying first and we do a warehouse replacement, the exchange of your relinquished property, that clock doesn't start until you relinquish it. So we'd have 180 days from the date of acquisition to sell what's going to be sold. To get that transaction done, we've got to give you ownership within 180 days of acquisition. And then if you've got excess funds coming from the sale or future sales, you would have that 180-day clock start at the time of disposition for those, and we could stretch out, going forward. So we had a partial reverse and a partial delayed transaction, and that's a blended transaction. So, if you've got a situation, we end up with this a lot of times when we're aggregating multiple relinquished properties into a single replacement, or we're going to take a single relinquished and go into multiple replacements. This strategy can actually help you get where you want to go, and it works very, very well. Partnerships. So remember, we talked when we were talking about the tax reform proposals, and we looked at that situation with the limited liability company distributions going mark to market. Okay, S's and C corps. Once again, if you've got the shareholders want to take assets out and then do exchanges, the distribution of the asset in and of itself is going to trigger taxes that are going to eliminate any benefit of a future exchange. That same situation may be applied to limited liability companies going forward if the Biden administration gets what they're trying to get done. So that would, imagine for those of you on this call that have properties owned jointly with other people, just going, for anyone out there that's owned a property with others for any period of time going forward, are you going to want to own the replacement property with the same people? What do you want to do with your funds on a future sale? And I tell people, look, when you're buying an asset, you think about what you're going to do going forward. So if you buy something jointly, make a lot of money on it, and it's jointly via a limited liability company, you've got in essence a partnership. Partnership interests are strictly prohibited from 1031 treatment. So we're going to have to do a drop and swap, or a swap and drop. A drop and swap means we're going to have a deed from the entity to the individual's predisposition. Ideally, that would be done maybe a year in advance. It never happens a year in advance because people don't think about it. Even if they think about it, they don't want to deal with it because it's cumbersome, time consuming, and can be expensive. So typically 9 times out of 10, that drop happens at close, and that's not a bulletproof transaction. There's lots of people out there that would express vulnerability in that situation, and the reason for the vulnerability is the entities own the property for investment. The change in ownership is really going to reset that whole clock, and now you're dealing with seasoning issues again going forward. So drop and swap is a predisposition drop, sorry about that. And then a swap and drop is a post-exchange distribution. And a lot of times what we'll do in that scenario is we'll do the exchange for the entity. We'll buy, let's say there's 5 of us in the entity. We'll create 5 new limited liability companies. Each one owns the asset that each one of us ultimately wants to own. So the exchanging LLC is the member of each of those respective LLCs. A year after acquisition, you do an assignment of membership interest from the LLC to each of the individuals that want to own each of those single assets. So that is a swap and drop. The downside of the swap and drop is that if there's lending involved with the acquisition, that it may encumber everybody. You'd have to change the financing of it when that assignment of membership interest occurs, and you just got to be aware of that. So the other thing is you're still in effect married to the group of investors for another year after you've relinquished that property, which sometimes people are okay with, other times they are not. And I want to stress once again, the bottom of this page, in a non-community property state like Oregon, for example, you might start up with a rental property, then get another one, then you get another one, then you go talk with your lawyers, and your lawyers say, gee, you've got a fair amount of liability now, so why don't you put them into a limited liability company? Then you sell that property, you go out and buy another fourplex. Well, 4 units or less are considered residential properties in the finance world, and LLCs are going to be more expensive to finance that acquisition. So, really think of what you're doing, how you're doing it, understand the difference, where you live, if it's a multi-member entity, what's going on with it. And by all means, people ask all the time, when do I want people to reach out to me when contemplating exchange? I'm going to tell you before you ever sell the property. Obviously, I tell people typically when you buy it, plan for the exit. You're not going to own it forever. So really take advantage of those people, the professionals in your life. Ask the questions sooner rather than later. Don't get yourself in a situation where you've got a sale pending and now you've got to look at these different issues. Joint ownership. This is another situation we've got a lot of right now, and I mentioned it at the top, where we're combining IRA 401k plans with tax money. So if you've got an exchange, for example, as we just talked about, partnership interests are specifically prohibited from 1031 treatment. You can own property with, jointly between you personally and your retirement account in 2 different formats. Typically, you can own it tenancy in common, or you can own it as common members of a limited liability company. Now, each has its ups and downs. I personally probably like the TIC better, but understand, just like a limited liability company's got an operating agreement, if you own things tenancy in common with different people, you need to have a TIC agreement that spells out what is going on and how you're managing the asset, the operation of it, all of that stuff. So make sure you talk, get your legal people to put a TIC agreement together. Even we're talking about a jointly owned vacation rental, let's say, where you go use it, and then one of you decides to sell it. How do you accommodate that? Who has the right to decide who's buying in, or if you can buy in, and what impact is there on financing in that situation? Well, the TIC agreement is going to spell out what would happen if one of you wants out, and financially how those things are going to happen. So the TIC agreements are critical, even if you have that vacation rental house with somebody else. I like TIC better when we're talking about combining personal and planned money, because one, it allows the 1031 into a jointly owned asset, and two, if there's problems with the property, you can always add funds into that transaction pro rata, right? If you own things as a limited liability company jointly, you personally and your plan, IRA 401k money, it's a prohibited transaction to transact between or for the benefit of a disqualified party with retirement accounts. It's not a prohibited transaction to transact along with a disqualified party. So we can easily combine any number of disqualified parties into a single limited liability company, and that's fine. The issue is if you needed more money, let's say. So the initial funding of the LLC is fine, but let's say 6 months, a year after you've made this acquisition, now some catastrophic event happens, you need to get more money into the deal. You can't just put money into the limited liability company. That would constitute money coming in from a disqualified source, would constitute a prohibited transaction to the retirement account and blow up the IRA. So you can't do that using the limited liability company structure. You can do that. You can accomplish the same thing using the TIC. And once again, the TIC structure, upon disposition, the qualified money would go back into the retirement account, and the personal money would go forward via 1031, or you pay your tax. If we're looking at the limited liability company structure, the entity would have to do an exchange. if you're looking at deferring all gains for you and that plan. Otherwise, you've got a problem there because the plan's going to have the deferral and you would have the tax consequence. So to have things where you're jointly owning stuff, you've got X dollars in your pocket or in your 1031 and you need more to get the deal done, you're free to add funds via IRAs or 401k plans. Notes in an exchange. This has been coming up a lot more lately. And I think seller finance is good for people if they want out. If you have somebody just selling a property, you're just selling a property, you want to put money in the bank today, you're not going to make anything on that money. Obviously, if you can shovel it into Wall Street, that's going to be a much better situation. But if you're just selling a property, you have the money in the bank's not going to do anything for you. And maybe you don't want to put money in Wall Street right now. So maybe a seller finance, a note would be a great opportunity for you. So what happens in that situation is if you're trying to do an exchange, the note's going to come to us just like the cash would. And then we've got to do something with that note. We can sell it to a mortgage broker. Typically discounts are sometimes as much as the tax liability, so that doesn't happen a whole lot. We can use the note in cash to buy the replacement property, so we'd be the benefit of the note at close. So the cash and note would come to us. We use the cash and note to go buy something. That doesn't happen very often because the seller of the replacement property doesn't know anything about your property, the buyer, or anything else. It could maybe be a short-term note where it's bridge gap finance. Maybe the buyer's financing fell apart and you've got timelines, they've got timelines that need to be met. You could do a note for 30 days, 60 days, 90 days, and it would just be in place until the permanent financing comes in. And then when the permanent financing comes in, all the money will be here and you can complete the transaction. 9 times out of 10, what happens is the taxpayer buys a note from us. You're going, well, gee, it's my note. Why would I buy my own note? And the answer is pretty clear. I've had actually people borrow money from the bank to buy the note. What's the cost of money in today's world? What's the note paying? I mean, if the note's paying you 5, 6, 7%, if you sold to somebody in the weed world, it could be 20%. So where else are you going to get that kind of return? Now, be aware that if you just sell and you decide, hey, I'm done with real estate, I'm just going to take it and sell it on an installment sale, make sure you understand that you're going to have tax exposure on debt relief and depreciation recapture in the year of disposition, even if you don't receive a single principal payment. So your down payment better be enough to cover any and all closing costs, plus any tax liability you've gotten, because you don't want to be stuck with a tax hit with no cash to pay it going forward. So understand what's going on there. But with that said, an installment sale could be a very nice end game for you. But if you want to defer everything, we're going to have to convert that note into something that's usable. Now, in a reverse exchange, think about that. Think about what we were talking about earlier. In a reverse exchange, when we buy that property, the taxpayer shows up at purchase with the money required to buy that property. We sign a note saying that we have borrowed that money from our taxpayer, all right? So if a future sale was an installment sale, that note is going to come to us just as the cash would, and we can use the note and cash to pay back the debt we've got. So even though seller finance in a delayed exchange can be very problematic, a seller carried contract or known trust deed in a reverse exchange can be very easily accommodated. So once again, what would happen is we're generating a note between the taxpayer and the exchange combination title holder, that entity. When we buy the property, that note is typically paid off with cash proceeds from a future sale, but that also could be paid off by using a note and or cash. So we've got a variety of weapons there, and that note in a reverse transaction can be very easily accommodated. Few examples and we're done. All right, and we're going to probably be about 10 minutes over. I apologize. First time I've given this presentation, so I'm sort of racing through it. Hopefully it's you're getting a lot out of it. But anyway, if we're looking at this transaction, really, it was a situation where the guy wanted to combine plan money and personal money. So we did an exchange out of the 7-Eleven, ended up buying some restaurant property. Ultimately, he was trying to combine the plan money and the personal money in the acquisition. At that point in time, understand if we're financing something with an IRA 401k, it's got to be non-recourse debt. So you're not going to have a situation where you're typically going to go walk in your friendly lender and get a loan. It's got to be from a bank that specializes in that type of space. And just for everyone on here to understand, non-recourse IRA 401k compliant loans typically are maybe 60-65% max loan to value. You would have tax on any income or gain with an IRA that's attributable to that leverage. So your equity component's tax deferred or tax free, depending if it's Roth or traditional. But income or gain attributable to other people's money, you'd have tax exposure on. But in this situation, we ended up just completing the transaction with his tax money via the 1031 because the lending was not that attractive. Ultimately, he did come back to us. We did a checkbook IRA for him, and he did end up leveraging in additional properties using the checkbook IRA. But once again, we were looking at a tenancy in common structure to accommodate his desires in this transaction, ultimately shifted away from it just because of the finance complexity. So this is an example just of a delayed exchange partial. Remember, 1031 is not all or nothing. So in this situation, the guy wanted to pull some money out, and they gave up a relinquished property, $3 million, bought a replacement property of $1 million. And so you're thinking, gee, $2 million in boot, that's a lot of money. Well, what happened is we still were able to defer $750,000 in gain. The basis of the relinquished property was $250,000. So we deferred the difference between the $250,000 and the million, saved them $250,000 in tax. So it's not all or nothing. Be aware that these things are out there. In this situation, you've got to understand also that these people ultimately moved into this property. So there's something called the Housing Assistance Tax Act, which is anything but. It sticks it to you. And if they were to have sold the property within 5 years of acquisition, it would be a fully taxable sale. After the 5 years, they would be entitled to a proration of Section 121's 250 or 500. And the proration is subject to what's called the Housing Assistance Tax Act of 2008, and that gives you a proration of the 250 and 500 based upon the amount of gain from 2009 to the conversion date. That would be non-qualified use, and the qualified use would be the time you lived in it. So that's something that has been in place since 2008. You're no longer in a situation where you can just exchange into a property, convert it after a year, live in it too, dump it, take the exclusion, get rid of all your gain. That does no longer work. Example here, just consideration for cash, smaller property. So this is warehousing. This is a transaction where people gave up property and a property came into us. So cash on the sale, and they took the other smaller units as partial consideration. The taxpayer didn't want it. We warehoused the property that was to go away. When it sold, we had the balance of the proceeds that were necessary to complete our client's acquisition and keep them totally tax deferred. So this is just a combination of things happening, but it'll take some time and planning. We can get you there. Tick foreclosure, recessionary periods. We've got a situation right now where we've got things going on, and we don't want to have a situation where people are getting properties foreclosed or short sales. Understand, gain has nothing to do with profit. Gain's simply a tax calculation. It's the difference when the adjusted sales price and your basis. In a foreclosure on a residential transaction, you've got tax relief. On income properties, you don't. So in a foreclosure on an investment property, if the debt exceeds the basis, you're going to be subject to something called phantom gain. And believe it or not, from that last crash, we were doing phantom gain, foreclosure transactions up until about 2 years ago. So it took us that long to clean up the mess from the last crash. I would anticipate if we have another, or not if, when we have another situation like that, we're going to be seeing the same thing. But understand the difference between tax relief on a foreclosure in a residential setting versus an investment transaction, which is not going to give you any of those tax benefits. And a lot of times what happens is the transfer of the asset has to happen before the foreclosure occurs. A lot of these are really assignments of membership interest from the taxpayer to us pre-foreclosure. When the property is foreclosed, it's ours, and we've isolated the people from actual or constructive receipt of the debt relief in that situation, not the increase. And they're going to come out of pocket a lot of times with less money than they actually had to pay in tax if they were just to realize the gain on that foreclosure. So those things are possible. Hopefully I don't have to do any more of those in my life, but it's up there just so you can see that it can be done if it has to be. So in this situation, we were looking at a warehouse transaction where we bought years previously, we acquired a property for this group of investors. They owned it tenancy in common. When the property sold, there were a couple of TIC owners that had 401k funds. So we pulled those funds out at close and completed the exchange. So when we went to buy the replacement property was going to be a large improvement exchange. So what we did, I call IRA 401k funds patient money. The 1031 is urgent money, right? So we had to get the exchange done for the TIC members. So we bought the property. Actually, we had to warehouse it, do the improvements, but ultimately when we gave the improved property, the taxpayer had satisfied their exchange. We used the 401k funds as debt on those improvements. So the 401k investors had convertible notes. So they wanted to be a participant in the acquisition, but the 1031 with the timelines, the scope, the size of the project, we couldn't give everybody ownership of the acquisition. So we gave the TIC members the property when we needed to complete the exchange. The qualified money was debt that those TIC members had. And then a year downstream, limited liability company was created. The TIC members contributed their property to the limited liability company, receiving membership interest attributable to their equity. And as that was happening, the note that the 401k members had, those were converted to a membership interest. Now you've got an asset owned by everybody that wanted to be involved. So once again, all the TIC owners are now members of the LLC. The debt holders are now also members of the LLC to the extent of that note, and everybody is where they want to be. We completed that project, and then they held it for a period of time, and really as we're presenting this today, we're looking at this project that was unwound a number of months ago, and now they're looking at a disposition, and we'll be resetting the thing for everybody once again. So the exchange is not just a single issue. We're talking about most of our clients are people we've worked with through decades of time. And it's a path from what you don't want into what you do want, and we're going to use a variety of tools to get you there. As I said at the top, the only dumb questions when you don't ask. I hope you're seeing a variety of situations that I didn't know we could do that kind of stuff. So anyway, in this example, actually, I don't think I'm even going to cover it because we're out. Actually, this one is just the last one. So I apologize. I was up late finishing this presentation. I had a duplicate slide that's just another one covering the same scenario. Final example really has nothing to do with 1031, but what we're talking about here, and I just like this presentation. I just want people to see what's possible with a good group of professionals on your investment team. By the way, which should include, you should have good tax people if you own real estate, investment real estate. Get good tax people you're paying for a position on things, not paying to learn on your behalf. Good legal people, same situation. Brokers, finance people, property managers, all these people have jobs, and I'm going to put myself on this team too, but take advantage of the resources out there. Ask questions sooner rather than later. Don't wait until you're behind the 8 ball to make things done. Good planning is always critical. All right. So in this situation, a couple came to us. They wanted to go buy a mobile home RV park with their retirement accounts. And we said, okay, we'll do something called checkbook IRA, which would allow them to make that investment. They then told us they wanted to be the on-site managers and live there. So they wanted to be compensated, live there. Both those things would constitute prohibited transactions with the retirement account. So we shifted gears into something called a rollover business startup. which in a nutshell means we're moving funds from wherever it was into a new 401k plan. The 401k plan bought the shares of the corporation then bought the park, and now with their retirement account, they got an investment, they got a place to live and a job, all with that one transaction. And I think that's pretty amazing. So never say never. In games, swap till you drop. As I said, that might go away. Be aware of it, talk to your tax people. But in today's world, it's possible to exchange until at some point you pass away, your heirs get receive the property, or property's stepped up basis, current market value, they could sell with no tax consequence. Exchange into a retirement residence. We have a lot of people doing that. We talked about that early on when we're converting assets from investment to residence, or residence to investment. Exchange until it makes tax sense. What do I mean by that? Maybe this year you're just killing it financially. You've got all very high income. Maybe next year you don't. Maybe this year you've got lots of stock market gains. Maybe next year you've got some losses there. So what we're talking about is either a reduction in capital gains, which is never a good bet, but maybe it's a reduction in gain that's attributable to your income decrease, or maybe we've got losses to offset the gains. That's what we're talking about with timing that transaction, exchange it until it makes tax sense. Exchange into a passive investment. DSTs are just crazy busy right now. My position on DSTs is work with one of the heritage players, somebody that's been through a hard time, because I'm sure we're headed towards another one at some point. You don't want somebody that's never been through one to be managing those totally passive investments for you. So, there were roughly a half dozen DST sponsors post crash last time. And at last count, there's roughly 52 of them today. So I would stick with one of the half dozen heritage players if you're looking at that space. You can talk to your financial advisors about that. They are technically a security, so you're not going to buy them through a real estate broker. There are some real estate brokers that have gotten licensed in securities and can sell those. But typically you're looking at somebody in the securities world. Installment sales we talked about earlier. A structured sale is just an institutionally structured installment sale. Basically, a third-party assignment company is assigned the obligation to pay you. And the beauty of a structured sale is you can literally create an installment sale over whatever term you'd like it to be. It could be just months if you want to shift gain from one year to the next, or it could be 20 years. CRTs, charitable and remainder trust, are another thing. Opportunity zones we talked about a little bit, and they're very popular right now. Understand tax deferral is only as good as the investment you buy, right? So don't exchange into something that's some risky proposition and end up, gee, I deferred my gain into this, but now I've lost all my money. So an OZ's development project is only as good as the developer, so make sure you're doing due diligence in that space. Gifting's always one of those things, and once again, gifting is one of the issues that we're talking about with tax reform, where you may not be able to gift things without having a mark to market going forward. So talk to your tax people about that. Do it sooner rather than later. And that UPREIT deal, I don't have it on the end game, but I think the UPREIT is sort of the ultimate installment sale. The UPREIT is a situation where, once again, you're buying into an asset the REIT absorbs, so you end up ultimately holding shares of that REIT, and you literally pay the tax as you sell the shares. So it's the ultimate installment sale, from my perspective. These are our firms. IRA Advantage holds and manages, works with self-directed retirement accounts, IRAs and 401k plans. Post 1031 is a property listing site. If you're a broker and you've got property you want to get in front of people, if I've got clients looking for things and they're not finding it, I send them to Post 1031. And then Equity Advantage is 1031exchange.com. This is our social media. If you're watching our YouTubes, which if you've got a question on something, there's typically going to be a video on it. But we have videos not just on 1031 stuff or IRA stuff. We've got videos on everything from charitable remainder trust to life contracts. And by the way, a life contract's a good place to get access to money these days. Instead of, if you're in a situation where you're thinking of letting that contract lapse, maybe you ought to talk to somebody in that space and sell it instead and have some cash there if you need it. So keep that in mind. But please watch our channels. If you watch it, subscribe, help us out, and like those, hit that like button. The other thing is that if you've got an issue, something that you'd like to see some more information on, you've got a topic you think would be helpful to you, it's probably going to be helpful to others, please reach out to Seymour at 1031exchange.com, and she will be happy to listen to what you'd like to see happen. And if it's something that looks good, we'll put it together and get it out there for everybody to see and learn from. Once again, David Moore with Equity Advantage. Thank you very much for sharing your time with me today, and look forward to any questions or concerns you might have moving forward. And if we can be of help, please don't hesitate to reach out. David Moore, Equity Advantage. Thank you. Best of health to everyone out there. Bye-bye.